IFAs, how are all my warriors doing? Let's have a great week. Everyone doing okay? Have a decent weekend? So even though most banks and the bonds are closed here in the U.S., we're getting some pretty good action across the board. Euro still has not taken out this low. I'd like to see him clean out these stops for perhaps something counter trend. If you watched Greg's week ahead video, he's allowing for, before we head to much lower levels, some type of C wave. Take us back up. I think he was talking about even cleaning out bears over this level and this level, which could take us to 19. So I'm looking for an attempt. My conditions aren't met yet. I'd like to see new lows. We're diverging very nicely on the 4 hour, so taking out these lows will not negate the divergence. Thinking that this might be a 1, 2, 3, so we'll see if we get it. I think something that is giving you a signal right now, in fact, you had to take the trade last night, was a short side of US dollar yen. Okay, we cracked. Remember I talked about we had an overthrow line. That's euro yen. We had an overthrow line in the yen. This is your 1 hour. Shows up cleaner on the 4. So this is when we accelerated, had the overflow. We're back inside the range. So this formation measures about 200 pips down to 12.5. So if we get the market coming back and a little risk on, anywhere up around 1350 or so, 1360, I think is a good short and could protect yourself with stops over 14 here. Everyone see that? Thank you, Forex Gal. Dennis, Marius, how are you? I was a little surprised by the pretty good weakness that we had in gold, but silver seems to be acting better on a relative strength basis, but we cracked this uptrend that we were in. I don't necessarily think, especially if we do get the dollar to turn, that we're just going to wash out to new lows and head towards, under 1160. So this 1192 area, I believe, is about halfway back. We had a $27 rally, 1216. Yeah, we're around the 61.8 back level. Still thinking that potentially we have, I could just adjust the lines here, right, and just bring it back down here somewhere, not sure. Hello, somebody. It could be here, but the big picture is it looks like it's a ascending triangle, which if we crack 1208 measures 1235, just based upon the count. But silver seems to have a better look to it today. See, we have a blue candle here. Had a couple of up candles before it happened. So, I'm thinking a lot of these things may be turned around Tuesday when we have the bond markets open again. Seems like bonds are trading, but they're, just aftermarket stuff. The cash market is closed. So I'm looking at dollar negative potential trades. We may as well go to the dollar itself. Stock indexes are trying to fight their way back. I'd actually like to see one more high here above this 96 level, maybe 96.20-ish to try it. So I've done nothing. Something that I've been talking about for a while, and I noticed Greg had talked about it. You remember I said, the Chinese said they weren't going to weaponize the yuan. And in my view, this was just corrective action. And we are going to make new highs in the yuan and take out this double top. Let's see how the market reacts to the yuan making new highs. I don't think risk will like it. So we'll see. It looks like it's on its way there. Let's see, is the lira about to give us some troubles? No, the lira is still tame, because I think the same thing is going to happen in the lira too. Today it's a little weaker and hasn't really regathered itself, but has the same type of confirmed high. So a lot of the currencies that the market was worried about a couple of months ago, I think may have to begin to worry again, especially with the yuan. You know, I learned this from being a commodity trader a long time ago. They're the best, the Chinese. In the grain markets, they would say they're canceling buys on wheat, and they drive the wheat market down so they could accumulate it. And then the things that they were saying they were bullish on, the market would go up and they would distribute it. So, you know, I always look for the opposite misdirection, and looks to me like their statement of the yuan not being weaponized is the trigger is cocked here, right? So taking a look at the S&P is just something I noticed. You know, it was a pretty negative week. ForexAnalytix was on top of it. Blake showed the Wile E. Coyote. I talked about the off number. But when you start looking at the 1 hour here, this looks like a pretty classic 2 drive. So you may want to cover up shorts at the next drive if we're over 30. Steve?
Good morning. I just wanted to remind that we also had that nice blog post at some point at the beginning of last week.
Oh, yeah. So, I mean, you guys saw it coming, rising wedge. Joe saw it coming. Joe was on Bloomberg and showed the rising wedge. He's probably going to become like Guru King of Bloomberg. He talked about, you know, the yen possibly coming off, though it's doing it today. So, you know, anyone who reads our content should not have gotten caught in last week's downdraft. So I'm going to be interested to see what you're looking for as far as follow through here, Steve. But definitely, we also talked about the Russell, even while other sectors of the market were here. I know you know, got on my high horse and did a tutorial on the Russell. And a lot of it was based upon Steve's target. I think it was 1.618 at 172.18, you know, and we were pretty close. You know, Steve will clean it up so he hits the high exactly. And then remember, we talked about this. I said, guys, you know, you got to write it down that when a market gives you too many opportunities and too much time to think about getting long after a major breakout, that be skeptical, you know, don't go for it because the markets usually aren't that accommodating. And then look for the failed breakout. So if you went with the failed breakout, whether it was this day or this day, it was a big trade. And we're all the way down to the 50-day moving average on Russell. So I'd be careful about potential bounces here. Yeah.
That's a 200, yeah. Coach.
That's a 200, yes. Steve may have a little, you know, discomfort in his body, but his brain is working. So my body feels okay, but my brain, I had brain freeze here a little bit this morning. But you have to sell rallies here because, you know, longer term, I think we could be headed towards 135 down the road. And I actually saw a count. It's so bearish. And, you know, maybe I should show it. I mean, this will make the bears salivate anyway. I saw it on Twitter. Let's see here. Steve, you won't even believe where this guy thinks the Russell could go to. And it's probably, I mean, if we are going to have that bear market, I don't know if it's now or next year, but check this chart out. This would have bears salivating. And, you know, I've seen this target before. It was way before we started that march to new highs, but here it is. And this guy doesn't have a lot of followers on Twitter, but check out his target on Russell. See that? 800. And, you know, this would be, I think, similar to 1550 in the S&Ps, because, you know, the highs in 2000 and the highs in 2007 were the same. So this guy's looking for eventually 800 in the Russell. Anyway, something to think about, and it's pretty clean, isn't it? It's a rising wedge, at least all the way from here, which is under 1,000. So everyone that thought they were going to be the haven, the Russell, I was always taught, Steve, that they're the tertiary, more speculative stocks and the small caps. So
listen, there's no question, Coach, that when the downhill begins, every single of the indices will have a lot of downside ahead, a lot of it, because as always, this stock prosperity was built on easy money, and as it happens in these occasions, we've already overshot anything that has to do with fundamental and logical valuations. So whenever the next trigger comes, and whenever because it's a self-fulfilling prophecy. I mean, the central banks tried to build a recovery based mostly on the wealth effect and the hope of trickle-down economics. But the problem with that, the problem with that is that once the wealth effect starts reversing, everything goes in reverse.
Right. I wanted, speaking of reversing, Steve, I wanted to get your thoughts on this, because you have a great mind when it comes to, the mechanics and dynamics of markets and structure. During this time that the Fed was very accommodative, corporations, the corporate debt market, all these big companies went to it because it was so cheap. They were just giving away money. The point is not that they, have loans, and to roll them over with rates going up is going to be more expensive. But what they did by financial engineering and stock buybacks is they leveraged their buybacks with corporate debt and dividends. So exactly. It seems like that could really accelerate a decline.
Exactly. That's going to be one of the pillars of the markets, of the bull markets undoing. The fact that,
unwinding.
As you said, exactly, the unwinding of that exact same process, which helped a lot, contributed significantly.
Yeah, because people have talked about there's there's not as much stock around. That's a bullish argument. From all the buyback, supply has been taken off the market. But if they have to pay more for their loan, and while they're paying more for their loan, what they use the loan for and leverage, like a margin account, is depreciating, it's like a double whammy. So, then they need more money to roll over on a depreciating asset instead of an appreciating asset. So, that's one of the scenarios. Huh?
Dale, hey, good morning. But meanwhile, the board of directors have got themselves paid very nicely for a few years, given that their stock price is going up, right? So
yeah, I think there's been pretty good insider selling. That's a great point too. I've seen some content that talks about, what's the name of the guy that heads Apple now? He did a lot of selling.
Tim Cook, yeah.
Tim Cook's been selling, who knows, what Zuckerberg's been doing, but there's been huge insider selling that hasn't matched what's going on. So, they have their parachute.
But something, it's, I mean, regardless, we can make a lot of arguments and start talking about the economy and etc. But let's just stick to the basics. What are the basics? We've been in an economic cycle that's already like the second longest we've ever had. We've been in the longest since like last month. We've been in the longest bull market in history. We know that we don't have the strongest economy in history because there is nobody in the right minds that doesn't understand that the economy we had at the 50s, at the 60s, etc., was much more healthy. And not only, even in the 90s, right? So since we know that this is not the best economy we've ever had, and we know this is the longest bull run we had, and we know that statistically speaking, there is, the very simple concept of mean reversion.
Right.
It's a matter of time to mean revert, right? So
what do you think mean reversion would mean in the markets? 30% minimum?
Depends, because the problem here is the following, Coach. Mean reversion would mean going back, let's say, to the normal trajectory of an ascending market, because let's be honest, a lot of people don't realize that, but inflation plays a big role. I mean, the tendencies of stocks will always be to steadily go up over a long period of time. Why? Because there is the function of inflation, right? So the cost of money depreciates. Even when we have low inflation, since it acts cumulatively, it still plays a role. So the long-term trajectory of the markets is higher. So there is a mean reversion, let's say, to a slow trajectory of appreciation. But when you actually overshoot insanely to the upside, usually this tends to act in the end like a spring that you've already pulled to its limit. So when you release the spring, it's not going to go back to, let's say, its neutral, its normal position and stay there. It's first going to contract a lot before it can actually rebound and go back to its normal, right? So that's the whole. Yes, Dale?
Sorry to interrupt. I mean, carry on. No, and I just want to add something basically to that.
Go ahead.
I was just going to say, what you're saying makes sense. What you're saying makes sense. There is one thing, though, which in my opinion will make a pullback smaller than we had, say, in 2008, where, remember the S&P went to 600 something. It felt like over, what was it, 60% or so? I can't remember. It was a lot. I think the fact that everybody knows the central banks are very well prepared now. Remember, they were cutting 25, 50 basis points at a time, 75, some central banks. We know that when this happens, and if it's something that looks severe, the Fed's going to cut, 50, 100. I don't know how much they're going to do, but the point is, the central banks that can cut will cut aggressively. The ones that can't will either go negative or start big QE again. So we can see what the effect of that is.
I think QE is not probably going to be the only tool. Helicopter money is going to be the tool as well, because they haven't admitted so. But and by the way, let me just say to people that are listening in, I think that these kind of conversations are extremely interesting, and you always need to have the big picture in mind. That doesn't mean that we're not going to go back to the charts, right? So we're going to start showing the charts and start doing technical analysis. So if you're waiting for that, give it 5 more minutes, and we're going to go to that.
So let us BS for another 5 minutes before we get to the real stuff of making money today.
Exactly.
Right.
So
all right.
So Stelio, one of the big problems is the following. We are always prepared to fight the previous war. The central banks are currently prepared to fight another incident of what we had as the financial crisis of 2008. Question: what if this is not what we're going to get this time?
Yeah, you're right. You're right.
What if this time we get stagflation instead of an environment that, yes, unemployment went down, economic activity went a lot down, but at least inflation stayed extremely subdued, which gave those extra tools to the central bank to use.
So QE next time, Steve, could possibly destroy the dollar and turn stagflation into extreme inflation because of things going up in nominal values with the dollar falling.
The point here is, this is not like wearing a tinfoil hat. The actual question, if we want to put it in context, is the following. The US, for example, has benefited has benefited for years, for decades, from having the world reserve currency. We've already started seeing several signs that parts of the world are trying to shift out of the dollar as the world reserve currency, right? That's an undoubted fact, number one. Two, the US is currently running a $1 trillion deficit in a period that there is no war, and theoretically speaking, we are in an expansionary phase at a booming economy, if I want to use President Trump's words. I don't agree with him, obviously, but that's how he calls it, like a booming economy, an economy like we never had, etc., etc. So, question: what happens during the next recession? And I think there is no single person on the planet that doubts that there is absolutely no way to ban recessions and never have one again. Most likely, we're closer to one than anything else. I mean, even from a statistical perspective, as we said. So what happens to the deficits of the US during the next recession? They double. The last time they doubled. So what they're going to 2 trillion, while the GDP will at least temporarily contract. And what does that mean for the faith in the dollar? Who tells us that the world is going to be willing enough once again to start funding, in essence, unpayable IOUs to keep on shipping products to the US so the US consumer can keep on having the standard of living that they have? So it might be a general dollar crisis. I don't know if it's going to be in the next, financial crisis, in the next recession. But, with how things are moving, I think it's a matter of when instead of if, you know what I mean?
And Steve, you're right. If you want to go back in time and see a theoretical equivalent state of the economy, the US economy as we are now, you should go back to the Clinton times, which is the last time the US actually they didn't actually run a surplus, but it was very close. So, and we're not doing that. You said it. We're running, they're running a $1 trillion deficit per year. So
record deficits, while the US is at peace. There is actually at the moment no war the US is fighting anywhere on the planet.
Yeah.
And theoretically speaking, we're still in an expansionary phase.
Yeah.
And you know very well, Stelio, that a lot of, let's say, economic stabilizers, for example, once you go in a recession, you start collecting a lot less taxes and you start having to pay a lot more liabilities because, for example, people suddenly start going unemployed, so you need to pay them unemployment benefits. Those same people might have been paying you taxes up until yesterday, and now instead of creating an income for the government, they're creating an expenditure. So a $1 trillion deficit, if you go in a recession, can extremely easily go to 2 trillion, especially if you're trying at the same time to, let's say, with some extra public spending, stimulate the economy to get out of the recession a little bit faster. And I'm asking again the question, who's going to fund all that? The Federal Reserve will start buying 2 trillion per year. And who tells us, what is the tipping point that anybody abroad, the Chinese that are selling the US so many products, what is the tipping point that they start saying, wait a second, we are actually using tangible resources to create stuff and send them over. And what we're getting back is promises of getting paid. But who tells me now that I'm going to get paid? And most importantly, who tells me that when I'm going to get paid, the dollar value of what I get paid is the dollar value that I actually thought I'm actually getting when I did the transaction, right?
Yeah, it's you're absolutely right. There is a point where all these questions start coming in, and we're probably getting there slowly. So,
yeah.
Okay.
So let's go back to the charts after
hold on. I have a couple of just things to mention.
Absolutely.
First of all, we had just a couple of things that happened overnight and this morning. China cut the reserve requirement rate by 100 basis points. I think big banks are going from 15.5% to 14.5%, and the smaller ones from 13 to 12 or something like that.
Is that why the bond weakened?
Yes, and that basically releases about $100 billion worth of funds. So it's gonna act as a growth spurt for the Chinese economy, and we saw on the back of that, the Aussie, the Kiwi are performing better than other currencies this morning. So that was one thing that happened, and they cut the rate 100 basis points, and they did say that this could be cut further. So that was one. The other thing that happened was in the UK, we had Theresa May voicing concern about how probable a deal would be. We had Juncker last week saying, "Oh, I'm convinced we can have a deal by November." The market loved it, and the pound was rallying. And May this morning said, it's one thing being confident about the deal and another thing actually getting it done. And she's a little bit more skeptical, or I don't know what game she's playing. We've said this a million times. I still think there's going to be an agreement in the end, but what kind of agreement? How will it get voted through? There's a lot of issues on the way. So that was one thing. The other thing, and the pound actually is under a little bit of weakness today. And then we had the usual Italians, the verbose Italians, Mr. Salvini saying that the EU, no, actually he said Juncker is the enemy of the EU or something like that, and he also said that austerity has damaged Italy and created more debt and has been quite negative. They use very strong language, the Italians, and these the ruling coalition, they're not your standard center field parties. They're a little bit one is left wing, the other one is right wing, so they get a bit vocal. And we saw the reaction today in the Italian bonds, which are taking another hit. And I think the spread to
the usual populist BS, the same things that they've been saying here in Greece. Austerity has actually been damaging Italy. The fact that there was absolutely no financial prudence for decades, and that got Italy to having like 2.3 trillion debt. Same deal with Greece, of course, and different numbers, but of course proportionally even bigger, etc. That was not the problem. The problem is that at some point somebody took the punch bowl away, and they said that okay, you cannot anymore live so much above your means.
Above your means, yes, exactly. Yeah. It's like saying, you did something and you're sick and you're getting some medicine which has some side effects, and you're saying, this medicine, it's all that fault. It's not.
And the patient said, like, no, if you give me a little bit more heroin, actually, that's going to make it better.
Yeah.
Sure.
Anyway,
of course.
It's scary stuff. I read it and it reminds me a lot of what we've been hearing here in Greece for the past few years. So it kind of scares me a little bit for the Italians. So that's basically just a quick roundup of what I think has happened overnight and this morning. And so yes, let me pass you the screen.
Thank you, sir.
Enter, no problem. There you go.
Okay, tell me when you can see me.
I can see your screen. I can't see you.
Yeah, okay. Okay. By the way, let me remind here that we also have a very, very nice webinar prior to this one conducted by Paul Franco, right? He goes through every day, like all the major levels for, the major instruments. But you have to be a ForexAnalytix member. One more comment on that. We had a little problem with mobile notifications on iOS devices that got fixed today, this morning. So just log out and log back in if you're not receiving them. Yeah, that's what I wanted to say before we go to the chat. So let's go through the majors first. Euro USD, as you see, the rebound was like very, very, very weak. We've come back to retest this 114.60 area. Personally, I see that the chances for breaching below it are decently high because this rebound is is definitely not one that inspires. Still, the fact remains that 114.50, 114.60 is a horizontal support area, support resistance area in this case, acting as support. The next target, the next downside target will obviously be a retest of the 113 area. Same deal with the cable. If you see here, I mean, I was monitoring this. First of all, the 133 rejection was a textbook rejection. 133 was a horizontal support resistance area. Also, that was the extension of the previous channel that was guiding cable's rebound for a decent period of time after the post-Brexit low. And in this case, this recovery has been an expanding triangle. We tested support, we're rebounding from there. But if we lose the 130 level once again, the chances for seeing a new low increase substantially. Obviously, a break above 133 invalidates that point of view and opens the possibility for a push higher to 136, but I think we're far away from that. So, and this is, as I said, not the main case scenario. I'm gonna devote a special, some special time for the indices, but let me go through some effects first. Now, one more thing, Stelio, you already mentioned that Aussie and Kiwi are performing a little bit better after the cut of RRR in China. Yes, on one hand, but the reaction is extremely subdued, you know, given the fact. So I have to say that given the fact that that was a bullish, theoretically speaking, development for correlated currencies, the fact that today, so far, we're just seeing like a consolidation, like a spinning top here in the Aussie, for example, is not inspiring at all. So having to do with the Aussie, we have to respect the trend. We have to respect this descending channel. I think that the chances of making it down to the 161.8% extension of this last recovery, which is at 69.43, are high. And, you know, don't try to fight the trend until we finally get some kind of a big reversal, because, you know, many times here we thought that, yeah, okay, you know, it's due for a rebound, but every single time the rebound was, you know, unimpressive and corrective in nature, and, you know, it kept on failing. The same deal here with the Kiwi. There you go. Kiwi has finally breached below this confluence of supports, and now it's targeting another confluence of supports, the 161.8% extension of the last corrective move higher. And as you see, there is a descending channel. Those two like coincide more or less at 63.75, 63.75. So there is a little bit more downside until we get to that. Yeah, obviously I wouldn't say, you know, you should be selling down here. I mean, it makes no sense. There is no, you know, risk reward. But that doesn't mean that, you know, you should be trying to already buy it. Now, crude is one of the most interesting ones. I also wrote it in the end of week analysis. If you go here in crude, this is the ForexAnalytix platform, right? If you go to crude, if you go to basic technical analysis, you're going to see crude got rejected. There it is. Crude got rejected from the confluence of the 61.8 fib from the June 2014 to February 2016 bearish move and the inverted head and shoulders formation target. So let's go back to the chart so you can see it. As you see, those two perfectly coincide here at 76.50. So I wrote that because it was quite interesting when you see like a big rejection from such a nice confluence of resistances that should immediately get you worried. And we have indeed seen a couple of days of follow through. Today we seem to be pushing lower once again. So I would be very skeptical about crude in the short term. Nothing has changed. I mean, the medium term trend remains higher. There's no question about it. But this has been, you know, a significant rejection. We're now approaching the first decent area of support, which is at 72.50. So I'm looking forward to see what's going to happen when we test that. If we actually break below that, the next area we'll be looking for is the 70 area. So I think you should be cautious with crude after this rejection. Now, let's have a look at USD CAD.
Steve, let's have a look at the metals as well. I'm sure you're going to have a look at them because they're crashing. Yeah.
Killing them.
Absolutely. USD CAD, very nice rejection from the 128 area. We were expecting that this move lower was corrective. I hope you watched the week ahead video. This week it was shot by, it was filmed by Grega. Grega mentioned USD CAD. I have mentioned it as well because, you know, this is, even if you're not following Elliott waves, this type of price action is very, very easy to recognize, and it's almost always typically corrective. Anyhow, USD CAD is now retesting the 130 area as resistance. I like the recovery so fast. I have a feeling that the chances that we found a low are getting higher by the day, especially if we do break above this descending trend line resistance. I think that's going to be all the confirmation you need, in which case I would be looking quite higher, perhaps towards the extension. As you see, there is a blue ascending channel here. Let me highlight over it so you can understand which one I mean. This one, right? So I think that if we actually break through that, there is a chance that we're going to make it towards roughly that area. So you asked for the metals, and I will happily have a look at them. Let's start by the most prominent ones, gold and silver. Gold, another attempt for a recovery, another rejection from the same area. Obviously not a good sign. Once again, do you remember how many times I've said that, Coach? Once again, and in my opinion, extremely suspiciously, they've been selling them prior to the US session opening en masse. And, you know, this is not normal market behavior. It's like somebody is always trying to dump metals, not every day, but very often they're trying to dump metals when liquidity is thinner, in a way that nobody would be trying actually to, you know, to sell something. And we're seeing this big move. I have to tell you in advance, yeah, this is another bearish move, and definitely, and what I wrote in the analysis yesterday specifically, if we want to talk about it, so you see that, you know, regardless of what kind of a position I am, we always try to have like an objective, you know, view to the market. Once again, gold closes the day right on the 1,200 support resistance zone, unable to confirm a bullish reversal, which would require a break above 1208. The longer it takes for the metal to accomplish that, the higher the chances that it will eventually fail and resume lower. So, you know, I'm just reading you my words that I wrote yesterday, because obviously nothing has changed since yesterday. As you see, there is a confirmation that, yeah, as long as we're not clearing that level to the upside, the chances of a failure are increasing. I wouldn't be surprised when we start getting some recovery from this move once people in the US start waking up. But as I said, unless we see a daily close above 1208, the chances that this is going to fail and push to new lows are quite increased. Silver made an attempt. I strongly believe that once we clear 1430 to the upside, there is no real resistance up to 1520. We failed actually a little bit lower at 1490. There was a little bit of a, you know, of an area of interest here. We had like this high, and, you know, that might have been it, because honestly speaking, the recovery in silver didn't look impulsive in any way. I thought that it might make it to 1520, but it's not that surprising seeing the type of price action that we had, seeing it push to new lows. Also keep in mind, just look where the RSI found resistance, roughly at 57. This is the kind of behavior you're expecting to see in a bearish market. I mean, whenever you have a recovery, you expect that the RSI should fail anywhere between like 40 and 60. You don't want to usually see above 60 if this is like a bullish correction, or you don't want to see below 40 if this is just a bearish correction and the trend is bullish. So, you know, a big move here, currently testing, you know, this 1430 area is significant. Let's see, as I said, now that the US session is going to kick in, if the bulls can defend this support level. If we do close below here, I think that the chances of new lows are extremely high. Okay, now palladium. As I said, palladium is by far the strongest one of the metals, but I do think that this little pullback is too little to indicate the end of a corrective move after, you know, such a strong recovery from almost 800 up to 1,100. So what I drew still stands in my opinion. There is a decent chance that there is at least one more leg missing to the downside before palladium can actually recover further. And let's have a look at platinum as well. Platinum recovering within an ascending channel, definitely, as you know, looking corrective, as well as what we've seen in silver and gold. So there's a horizontal support resistance area here, roughly at 800, a little bit higher, but okay, let's call it 800. I think that if platinum breaks below the 8, especially closes on a daily basis below the 800 level, there are very, very high chances that it's also going to push to new lows from there. Stelio, before I go to the indices, is there any type of question we have for FX? No, actually, let me also cover USD
we don't
yen.
actually, so we don't.
Okay.
So carry
Okay.
if you want.
Now, USD yen, I was following this ascending channel. We stalled at the 127% extension of this move lower. And, you know, I thought that this is going to be the place that we're going to see like a bigger pullback. And as the market usually likes to do, what it does after that is like it creates like a big bullish candle. It gets everybody trapped being long, and then it completely reverses. And we're now back retesting the previous high and threatening with a break below both the channel and this horizontal support resistance area. Added to that, if you go down to a 4-hour chart and you have a look at the USD yen, what you can see here is that this is likely a head and shoulders formation, right? There it is. So I think there are decent chances for more downside for the USD yen. We've already broken above this ascending trend line as well. So I would be quite careful here, because the market, we had seen both from the COTs and especially from the DSI, that the market was too short the yen, and the yen, not USD yen, right? Too short the yen. And, you know, this can very, very likely result to, you know, the market just pulling back significantly and getting people trapped at the worst possible point. Why not? We might even see, you know, a pullback down to 111.50. That obviously bodes quite nicely with the fact, and I'm actually going to start by having a look at the Nikkei before I go to the more popular indices. The Nikkei first pushes to 27-year highs or something like that, something extreme, and then after it stays there like for a single day, it pulls back, it manages to close above the previous high once again, and the next day, but the third day, it just collapsed completely. So I bet a lot of people got trapped long there as well. And, you know, this move might easily end up being corrective, but I don't really see any proper area of support until we find the 23,000 area that acted several times as a resistance until we finally managed to break above it. Anyhow, my words when we were testing and retesting the 23,000 area is that if we break above that, I strongly believe that we're going to retest the previous high and perhaps even break above it. Both of those events happened, but the fact, as I said, that we failed after just staying like 2-3 days above it is something that should obviously be troubling the people that got involved with this trade at the very late stages. Now, S&P 500 has already done the first move. What is the first move? The first move is break below what could have been interpreted as an ascending wedge. To do that, you can just see this blue trend line from this channel and this ascending red trend line, right? So this is step number one. Step number two is clearing this horizontal area of support, which is roughly at 2870. We tested that on Friday and we failed. I mean, the market recovered from that level, proving once again that that is a significant level. So 2870, extremely important. Now, if that actually breaks, then the only thing holding the market is this ascending channel support, but the chances will be that that's not going to do the trick, in which case I would be looking for 2790, which is this horizontal support area. Now, if 2790 fails, there is a lot more downside left after that because we're talking about levels below 2700. So as you see, the move higher in the S&P was obviously bullish because we remain in a bullish trend, but the momentum was not really that inspiring as what we had seen preceding that mania phase that ended in the end of January. So this recovery looks a lot more unimpressive. RSI divergence on the daily chart is very clear. Even more, let me show you here, even more worrying should be the fact that we have very clear weekly RSI divergence. Just look at the weekly reading, like above 90, and currently we're just below 70. And even if you go to a monthly chart, just look at this divergence in the monthly, which means that, you know, we did get new highs, but every single momentum indicator from the daily and above was very, very, very clearly divergent, and that should be worrying. Okay, now the worst performer was not the S&P, but actually was the Nasdaq. The problem with the Nasdaq is that it has now cleared this much cleaner to interpret ascending wedge. I had been monitoring that since a long time ago, before it even was obvious that it was an ascending wedge. I started talking about the possibility of an ascending wedge forming here, roughly when we were, you know, at current levels there, where I'm marking. And, you know, it has indeed formed as one. So now on Friday, we actually closed below this ascending wedge and just below previous support levels. If actually we confirm this, the next area of support is down here, as you see this horizontal support resistance area. And if we also clear that, I really believe that the chances that we're going to make it all the way back to the beginning of this wedge are quite significant. So have the bull trends broken in the markets? No, they haven't. But do they show very worrying signs that we might be getting close to that? Yes, they do. And that is not only isolated in the US stock markets, but look at the DAX. The DAX failed from the 12,400 level and is once again approaching the 11,800 area. And why is that important? Simply because this is the neckline of a huge head and shoulders formation. So 11,800, if we actually close below that on a daily closing basis, I do believe that everybody that's long is going to be running for the exit. And, you know, when everybody's running for the exit, we know what that does to a market, right? The coach mentioned also the Russell. So let's have a look at the Russell. The Russell clearly was overextended any way you saw it. Even, you know, I had two channels that I was monitoring here. You can see them, two bullish channels, both of them confluenced almost where we got rejected. Also, there was like an extension here that rejected us. I don't have it anymore on my chart because, you know, I don't want to have too much noise. But look where the Russell found a low on Friday, and that is on an extremely significant confluence of supports, because it's the 200 daily moving average, and it's an area that acted twice as resistance and then acted once as support. So needless to say, very big move lower, getting rejected from an area that, you know, it was very suspicious to produce a rejection. What happens from here is going to be key for the trend, because if we do break above this 160 area, I believe there is a lot more downside coming. But be careful, being short so close to this area is obviously dangerous, because, you know, the risk reward, I mean, if you wanted to be short up here, it made sense. But if you want to be short right on this confluence of supports, it makes not much sense. Selling a rally, though, let's say to 164 makes sense, right? Coach said it before, perhaps it's now on sell the rally mode, and yeah, it looks very, very likely. FTSE made a nice attempt of a recovery. I expect one more low. The fashion in which it rebounded, instead of producing like a bear flag, reduced the possibility that there was one more low coming. But, you know, obviously that was a trap, because as it seems there is one more low coming, in which case I would be looking towards the 7,100. As you see, FTSE acting on a very heavy manner as well, considering the fact that the cable is also selling off today. The fact that, you know, the FTSE is also selling off tells us a lot that, you know, the market is currently, at least in the short term, very weak. Stelio, any questions?
Somebody was selling the idea that XAU will go in the other direction last week. As someone saying, last week it did go in the other direction.
Gold.
And also, we don't sell ideas, okay? We talk about our analysis. We're not selling it. We realize that there's two sides to every market, and you know what? People could have opposite opinions on a market, and both be right, depending upon time frame, and both be wrong.
First of all, I know very well what I've said on the webinar, and I know very well what Gregor has said on the webinar, because I was there. So, and I know what I've said in the chat room. I was, and I'm still long gold. I said 100 times that I'm looking for a corrective rebound, and Gregor said the same thing, that he's looking for a corrective rebound, but he's looking for a lot more downside. So, you know, whoever has heard this webinar, they know that even if we don't get a higher rebound that I was personally expecting, and I think Gregor was expecting it as well, when you're talking about a correction, obviously you acknowledge that the trend remains lower. And as you see, I read you word by word my end of the week analysis, which was written on the Friday, you know, after Friday's close, which gold was a lot higher. And still there, what I mentioned was that as long as we don't close above 1208, you have to be cognizant of the possibility that the metal is just going to break down and continue lower. So, you know, even if, you know, first of all, nobody can be right all the time.
Anyway, Steve, live and face the last 2 weeks, I gave pretty great entries for the long side of both gold and silver. 81 at 61.8, and then last week 85, 87. You know, it was good for $18, which is a great gold trade. And silver was good for 40. And you know,
And
I believe in, you know, you don't go broke taking profits. So I came in flat. I'm surprised by the extent of the weakness, and now I'm in an I don't know phase. But you know, yeah, I trade both sides of the market. But
yeah, and everybody should trade both sides of the market,
yeah,
in my opinion. It's a
yeah,
bad thing being only a bull or only a bear, because first of all, statistically speaking, it reduces the available trades you by half, right?
yes, yeah.
So even
And
if you want
sometimes
to
the
look,
setups are
yeah,
very low risk, even though you may have a weekly or monthly trend in one direction. You might have a 4-hour daily move in the other direction.
absolutely,
Yeah.
absolutely. There's no question about it. Yeah,
But I don't
absolutely.
think we sell ideas. You know, we're not trying to push anyone. In fact, we say, you know, this is what we think. This is our research. But you know what? You should have your own and not be totally dependent upon what we do here. Although I don't think you'd get hurt being dependent. But if you want to be a trader, you don't want to be dependent on anyone. You want to be completely independent and then maybe do some intelligence gathering from analysts you respect. So
Yeah,
that's
and
another point.
you know, one thing I have to say is that some things are just mathematically proven. So anybody that sells you the idea that they're always right, they don't know what they're talking about, right? But I can tell you one thing for sure: ForexAnalytix is live since July 2016. In that period of time, we have issued 534 patterns in play, which have yielded this performance in as a return, right? And we've been right like just 53% of the times. The secret is, I mean, we're right in our patterns in play just a little bit more than we're wrong. But the secret is, as always in trading, when you're right, to gain more than to lose when you're wrong, right? That's the secret to trading. So to have a proper reward to risk ratio, and even if you're 50% right, even if you're a little bit less than that, you can achieve, you know, a good performance. And whoever is a ForexAnalytix member can testify to that, because you know we have full transparency. Every pattern in play is there since the day we began, like pages and pages and pages of patterns in play, which are anyhow indicative, because our goal in ForexAnalytix is to have a very nice community. We have an amazing chat room in which we share ideas for people to see our analysis and get acquainted to more patterns, to more forms of technical analysis. They can start getting into harmonics, Elliott waves, etc., to feel more confident about the trade they want to take. Because, for example, if you see that all types of analysis like basic technical, harmonics, Elliott waves point to the same direction, obviously the chances that that's going to be the right direction are significantly higher. And to teach you how to take the right decisions for yourselves, right? If we wanted to make a trade copier service, we would have done so. But, and I'll tell you something which is like, let's call it a professional secret. As you know, we've been working with Forest Park FX, and you should definitely go pay them a visit, because they're going to help you find, you know, the broker of your needs. If you go to our reimbursement page on ForexAnalytix, you can speak with them over Skype, or you know, send them an email, and they can hook you up with the best broker for your you know, for your needs. But I can tell you something: they have told us that the people that come from ForexAnalytix are by far the best segment of clients they've had, because they stay longer in the markets. And I'm not saying that to say it; I say it because they've told us so. So we know that we do a very good job in helping people not get chopped up in the markets, right? And teach them how to do this properly. And, you know, we're not promising like rainbows and unicorns, just, you know, that this is a community of people that know what they're doing, and you can be part of it. Coach?
Yes, sometimes people need to have a different experience to know what they had. Yes, I'm here, Steve, and our guest also has arrived, so we could start at any time. And again, Great clarity again from you, Steve. I miss you when you're not around. Stell, great job. Blake who, that's all I could say. You know what I mean?
Stell, I think he's picking up the kid.
Yeah, all right. Okay, so thanks, Steve. Don, welcome back to FACE. I'm really interested in your presentation in light of what happened last week in the markets, and want to talk about if we're in this rainmaker scenario. I just passed you the controls. Everyone, welcome Don Mead at 7 Sentinels is his Twitter handle. There you are. See his handle up there. Okay, waiting to hear your voice, see your screen.
Can you hear me?
Got you, Don.
You can hear me?
Yeah, very loud and clear, my trading warrior brother. How are you today?
Super, Dale. Really good to be with you, and I'm very honored.
Yeah,
Thank you very much.
Great to have you back. You know, I love your handle. You know, sentinels are guards, and you know they protect things, and you know your sentinels are technical conditions of the market, and I'm interested. I sent you a tweet. You said that the whole crew is AWOL right now after the declines we saw last week.
They are indeed.
All 7 of them are out chasing women around somewhere.
I guess they are.
Okay.
They are.
Okay, so go ahead.
Well, by the way, the reason I came up with that name, 7 Sentinels, is that I've been a great fan of Jesse Livermore my whole trading career, which spans back several decades. And Jesse's #1 concern or philosophy with regard to markets is just simply that there aren't bear markets or bull markets. Well, let's put it a different way. There isn't a bull side or a bear side to the market. There is only the right side to the market. And the right side to the market, he called the line of least resistance. So I set about for years and years to find a number of sentinels, if you will, that would tell me what, at any given time, the line of least resistance truly is. Because if Livermore is right, and your objective is to trade with the line of least resistance, I wanted to find a way of identifying the line of least resistance, and I ultimately did so about 10 years ago with my 7 Sentinels. So that's the history of that.
Okay, and why is the number 7? That's a number of completion. Any reason for 7?
That's actually a good reason to use 7, completion. Okay. I just found that by putting these 7 together, I had essentially completion, if you will, of the accurate description of the trend of the market. No particular reason for 7. It just worked out that way.
Okay, yeah, it's a lucky number. All right, so you know, I'm sure after last week, Don, there are a lot of people saying, "No, you know, it's another dip to buy," and you know, the candles on the weekly for me, especially in the NASDAQ 100, was pretty damaging. Hard for me to see how we're gonna, you know, I'd be very surprised to take out last week's high. So show us what you're looking at and what the Sentinels are saying, and make your case.
Oh, you betcha. Thanks, Dale. You know, King Solomon said several thousand years ago in the book of Ecclesiastes that there is nothing new under the sun. Then a few thousand years later, a young...
but Don, didn't he also say that men toil under the sun for nothing?
He certainly did. He certainly did.
We could replace the toil with trade, but
That's
we
right.
don't do it. Okay, go ahead, buddy.
Well, several thousand years later, a young speculator by the name of Jesse Livermore said that Wall Street never changes because human nature never changes. And what he was saying is that markets have never changed, will never change, and will always react in the same way, because human nature never changes. And this is basically what King Solomon was telling us thousands of years ago. I think maybe the best, I should tell you before we get started that right at 6:30 when the market opens, I have to place some trades. So we'll kind of speed through this and make sure that we get done in that period of time. But at any rate, let's take a look at, let's go back to the year 2000, since we're talking about markets never changing, markets repeating. By the way, I would say, Dale, that you and I have a job simply because of the truth of that factor. If it weren't for the fact that markets never change, you and I would never have been able to come up with what we do, which is to identify patterns in the market, to identify recurring patterns, and to be able to then project what is going to happen in the future based on the recurrence of those same patterns again and again and again. Nothing is new under the sun. But at any rate, let's go back to the year 2000. Here is the year 2000 for the Standard & Poor's 500, right from January up to October. And notice that the Standard & Poor's 500 made a high early in the year, in this case in March, at around 1526. They went into a nosedive and then worked their way higher all year long, and then poked their head up above that 1526 on the first day of September 2000. Now, notice this. Look at what the advanced declines did in that same period of time, from early 2000 to September of 2000.
Yeah, price almost at new highs, and AD maybe halfway back.
Substantially lower, exactly right.
All right.
Also, the number of new lows. Well, we'll get onto some of the other things. The McClellan oscillator was substantially lower. The percentage of stocks that were in point and figure buy patterns was substantially lower in September. And that was true on the NASDAQ as well as on the New York. But at any rate, let's jump forward now to the year, well, since I see what just popped up here. Here's a larger view of that March 2000 top, September 2000 retest with much weaker internals, and here's what followed. For the next 2 years, the market dropped like a stone. It dropped in half. And it's because we had that setup from early 2000 into the fall of 2000. Now let's skip forward to the year 2018, this year, and here is, in this case I used the industrial average just because I was doing some other work with the industrial average when I did this particular chart, but here is the industrial average making a new high in late January. It actually peaked on January 26, 2018, made a high it had never seen before, and that was an all-time high. And then the market came down just like it did in the year 2000, worked its way higher, and finally made a new high in October, early October 2018, this month. And notice again, the advanced decline line has already peaked back in August, and as it made a new high, it was substantially lower. The number of new highs came steadily down. The number of new lows grew as we came up to that new high. Here is the New York Stock Exchange high minus lows on a 10-day average, the net new highs. They were 250 back in January of 2018. And
these internal studies are your sentinels.
No, these aren't my sentinels, but my sentinels are very similar to these.
Okay.
They are.
These are standard. These are standard. Everyone looks at these.
Yes.
Okay.
So in October, the number of the net new highs on a 10-day average had fallen from plus 250 all the way down to around 80 at that October 5th peak this last week. Same thing for the McClellan oscillator summation index. It had dropped from 750 down to about 0. It's going to be minus today. It'll be below 0. Same thing with the percentage of stocks on the NASDAQ that are making point and figure new buy patterns. That number was 70% back in January, and it has fallen all the way now to 49%. Less than half of all NASDAQ stocks, are in buy patterns. Same thing with the New York Stock Exchange buy patterns, the BPNYA, which is again the percentage of stocks that are making point and figure buy patterns, that has fallen dramatically. Same with the number of stocks over their 200-day average has fallen dramatically over the balance of the year, and so has the number of stocks over the 50-day moving average. And you can see what the Russell 2000 has done just now in the last 5 or 6 weeks. It's dropped 8%. So what has happened is, as the market came up and retested the old high that it had set on January 26, 2018, all of the internals were very substantially lower. So that is really the picture we're looking at. We're looking at a market that has internally been falling. The way I look at this market is that it actually peaked not on October 5th, 2018. It peaked, it peaked between about November of 2017 and, like you say, February of 2018. That's where the real peak was in the market. This is our weekly market analysis, which went out yesterday, or which we posted yesterday, and people read then. And in that, we showed what has happened to the market just in the last 2 days. 2 days, yes. We have the Dow achieved its nominal new high closing of 26,828 2 days ago on October 3rd, 2018. And look at the technical damage that has been done just in the 2 days of Thursday and Friday after that new high. The advanced decline line, as we showed, has dropped dramatically. The number of new lows has actually grown to, on Thursday and Friday, they averaged over 400 new lows per day. Now think about that for a moment, Dale. Of all the stocks that trade on the New York Stock Exchange every day, which is just over 3,000, 400 of those issues broke through their lows and made new lows, new 12-month lows on Thursday and Friday. And that's just, that's 13% of the entire list, and that's just 2 days off the all-time high.
How far back is that other red bar? That's
this one right here. That was what happened after the January 26th high.
Okay. All right.
So this is a 1 year period of time. Thanking you for putting this a little bit more in perspective, and that is what we are looking at the last year. Here are the net new highs, having dropped from just a month ago about 80 net new highs a day, or in January we were having 250 net new highs per day. Now we're at negative 130 net new lows per day. And I could go on and show you each one of these individually, but the point is that the damage that has been done in the market in the last 2 days is almost immeasurable. And we can quantify it, and I have, and those statistics are in the report that I wrote yesterday. But when I say immeasurable, I mean that it's hard to even quantify how badly this market has taken it on the chin and what that's going to mean for the market looking weeks ahead.
Is there anything in your methodology that would give you targets or objectives after you identify that we're in a weak period? You know, how much of a decline should your subscribers be looking for? Because you know, you never go broke taking profits, so there are probably some levels as well where you might be willing to lighten up on shorts.
Yes, that's a very good point. The short answer to your question is no, I don't project levels. It just isn't something that I do. It isn't something that's part of my work. What I do is quantify at any given time the direction of the market. And I am always keenly aware of what the direction of the market is at any given moment based on what my 7 sentinels are telling me. And they are telling me in the most definitive, absolute way that that trend is down. Now, to though further amplify that point or answer your question just a little bit better, when you take a look at how badly the markets are diverging, how serious are these non-confirmations, you can get a feel for what's to come. The more serious the non-confirmations, the more serious are the declines in the internals ahead of the move in the market, the bigger that move is going to be. So I can say this: of the tops that we had in the year 2000 and 2007, this top is every bit as serious. And I would look for the declines over the next 2 years to be every bit as as much amplitude, right? Okay. As we saw before. So I would say at a minimum that we're going to see a 50% decline in the Standard & Poor's 500 over the next couple of years. Frankly, it can be a lot more than that because I'm seeing some serious problems with this market that are far more serious in 2007 and as serious as the year 2000, maybe more so. So we're looking for a big.
You play this through bearish ETFs, Don?
Yes,
rather
absolutely.
Than futures.
Yeah,
Why do you prefer the bearish ETFs, like the 3 times leverage ETFs over futures?
Because futures give you unlimited risk. If you're short a future, there's no limit to how much that can go against you. You can protect yourself with stops, but the overall risk is unlimited.
Yeah, I'd rather be wrong for a week in SQQQ than NQZ.
Right, exactly. You got it.
I hear you. Okay.
And options, I love options. In fact, I'm looking to buy some options here in about 10 minutes when the market opens. But some put options. But options have the disadvantage of having deteriorating time value. And if your timing isn't just precise, that deterioration is just going to kill you. Right. So those are the 2 big disadvantages. I like leverage. Leverage is a wonderful thing. But if you're shorting, by the way, if you short the market with a margin account, you have 2-to-1 leverage, but you have to go in and borrow those shares every time you make a trade. That's a big hassle, and it slows your way down, and you don't know if you're going to be able to borrow them. You don't have that problem with ETFs. So that's it. All of the alternatives to giving you leverage in the market have downfalls that I don't like. ETFs don't have those downfalls, and that's why I prefer to trade them.
Where do you think I had to chuckle a couple of weeks ago, Don, one of the anchors at CNBC, when the Dow was down and the S&Ps were down, but NASDAQ was ripping, said that investors were buying the FANG stocks as a flight to safety trade.
Right.
And anyway, are there any other places to hide and go besides being short the market during time periods like this that you pay attention to?
Not that I pay attention to. I'm just a pure market trader,
okay.
and for that reason, I really can't answer your question.
It only takes one.
Here's what I would say: if you're looking for alternatives, check with Dale Pinkert, because he's got plenty of them. He knows more about the metals market than I'll ever hope to know.
But well, I know you want to get set for trading in about 9 minutes. So
yes.
What do you want to wrap it with, buddy?
I guess just this. Do you remember did you watch the movie Margin Call?
No.
Oh my gosh, Dale, you have to watch it.
Okay.
It is just a phenomenal movie, and it has so many parallels to what's going on right now. But there is a scene in Margin Call when the guys that have come up with this model that tell them that the market's ready to crash are in their car. They're driving. It's early in the morning, but there are a lot of people out on the streets. And Peter Sullivan says, look at all these people wandering around with no idea about what's just about ready to happen. No idea what's about to happen. And
I said that to my wife yesterday on the way to my in-laws.
And I think about that all the time.
Yeah.
That's where we are. And the fact, though, is that it doesn't have to be that way. You don't have to be unprotected. You don't have to be in the dark when it comes to market, because the answers are there. The repeating patterns are there, and you can be prepared. And in fact, you can not only protect yourself, but you can make a tremendous amount of money from these abnormal moves, the declines.
Although both you and I have been premature at times.
True. That's okay. Absolutely true.
Okay, so but the difference is, to be there for the good times, you have to be there all the time, right?
That's right.
And keep attempting it. So, Don, what's the best way for our listeners, viewers of the video later, to reach you? I know I've given out your Twitter handle. Maybe you want to show your website.
You betcha. Thank you very much for reminding me of that. 7sentinels.com is where we are. And you can log into 7sentinels, or I should say, you can go to 7sentinels.com, and right down at the bottom of the page, you will see a number of links to articles that are available to everybody. You don't have to be a member to click on these links and read articles like...
Oh my God, When Worlds Collide, is that Planet X?
When Worlds Collide...
Planet X going to bump into Earth?
I'll tell you, worlds collided in the year 2000 when a secular bull market that had taken the Dow from 550 up to over 10,000 bumped right squarely into the onset of a primary bear market. That was a collision of markets. We had it again in 2017, 2018. It's the same thing all over again. I recommend that article, When Worlds Collide. I think there's a lot of useful information there. Another one is Red Sky in the Morning. It talks about all the warnings that have popped up over the last year, and there have been a massive amount of them. And they are the most severe warnings in history, or at least of the data that I can find studying over the last 100 years or so. Well, let's see, the line of least resistance, several good articles down there. I would say just check them out. Also, right here, limited time trial. If you click on that, for just $9.95, you can have 14 days of 7 Sentinels to take a look at it and see what impact it has on your trading. You can see we publish every day, every night, every weekend. All of our trades, all of our setups, all of our everything is right there. So
I have an interesting question from an attendee, from Ben Morgan. He said, could you ask Don if it worries him that every time we've had a pullback for the last 6 to 7 years, that these crash calls immediately come out by tons of analysts?
Sure.
Does it bother you?
Oh, yeah. Sure it does.
Okay.
I don't like saying that, but I have to go with what my work tells me, and there's always a hook in the market. I don't know if you remember Joe Granville, but he used to always,
do.
Yeah, he used to talk about the fact that there's always a hook, something that hooks people. And
he also said what's most obvious is obviously wrong.
Exactly. But he said that there's always a reason that people say, well, this time I don't quite believe it. I know everything's set up right, but we got too many people calling for a crash. That can't be right. Well, that's probably the hook. Anyway, that's what I'd say about that.
Well, Don, I want to thank you a lot for coming in. I've turned off this alarm. I don't know why it's continuing. Hold on. So I wish you this to be a rainmaker.
Thank you.
For you and all your subscribers. Good hunting, and thanks for being a watchman for people that may stay a little greedy and possibly a little too naive, a little too long.
Thank you so much, Dale. I can't tell you how much I appreciate what you do, and it's really an honor to be here with you, so thank you.
Oh, well, I'm a fan of yours, Don, as well, so good hunting. Have a great fall trading season, and look forward to seeing what kind of outcome we have. Maybe we'll get together in a few months, and for sure early next year. Okay, buddy?
Good. Would love that. Thanks.
Okay, Don. Everyone, that's Don Mead. You can follow him at 7 Sentinels with an E, not an A. So you could tell he's popular when people try and imitate him and use the same handle, only change a vowel. And you could find him at www.7sentinelswithane.com. So I'll see everyone for Turnaround Tuesday. Good hunting. And remember, don't just count your pips, count your blessings. See everyone tomorrow. Adios. Thanks again, Don.
Thank you, Dale.